Okay, good morning, everyone, and welcome to what is the 66th edition of the Coffee Microcaps Morning Meeting. You're all very welcome to this morning's event. My name is Mark Tobin. I'm the founder of Coffee Microcaps, and I'm just going to run through a couple of intro slides, and then we're going to get straight into it with our first presenter. I'd like to give a special mention to DMX Asset Management, our sponsor, who helped keep these events free for attendees. So very thank you to the team from DMX. A quick compliance and disclaimer slide. For anybody who's joining us for the first time, the companies we normally have presenting on here are capped under 300 million, are in revenue and approaching cash flow break even, or indeed are already profitable. They're generally from outside the resources and biotech sectors, what I like to call industrial microcaps. That could be industrial technology, financial services, professional services, industrial and consumer services, basically anything that doesn't encompass biotech and resources. Structured this morning's webinar, we've got 3 companies presenting this morning. Each is going to have roughly a 30-minute slot, which we break down into a 20-minute prezzo, and then we throw it up in the Q&A for about 10 minutes. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate to our presenters. And please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel tomorrow morning. You can follow us. We're on kind of all the social channels, Twitter, YouTube for the recording of this webinar, as I said, and indeed all other webinars in this series are on there. We've got quite a bank of content on there now if you want to check out some of the previous presenters, LinkedIn as well. All 3 of our presenters this morning are actually returning presenters. So first up, we're going to have Grant Dearlove, Executive Chairman of AF Legal Group, who'll be joining us momentarily. After that, we're switching to another Grant. Grant Hackett's coming back to give us an update on Generation Development Group. And finally, I think we're welcoming back for the 3rd time, Dr. Chris Richards, Managing Director of Apiam Animal Health. So without further ado, I am going to hand over to Grant. So I'm going to stop sharing my screen now. Grant, if you want to start sharing your screen, it's coming through now. Yeah, I can see the cover slide of your presentation now, Grant. You're good to go, mate.
Thanks, Mark. Can you hear me okay?
Yeah, audio sounds perfect.
Fantastic. Thanks, Mark, and thanks for allowing us to come back on to Coffee Microcaps, and good morning to all that are attending this presentation. I'm conscious that we have, viewing the presentation today, some existing shareholders, some investors that are considering us as an option in their portfolio, and thirdly, some new people to the value proposition of what we represent as the only listed family law firm in the world, and the first in Australia. So what I thought I would do is go through our half-year presentation, so that I don't get a slap on the wrist from the company secretary. I've kept the slides the same as those that have been published on the AHX, but I've just moved them around because I think today is a good opportunity, having been on Mark's show about 8 months ago, to reflect on our growth and our success. And I want to emphasise for some of the existing shareholders and those that are considering to invest in us some of our competitive advantages that we often sort of skim over in these presentations, but really go to the core of our success, our dominance in the market, and where we can take ourselves as this listed family law firm. And I'll spend some time on the financials and what the future holds. So most people know us as the only listed family law firm in Australia and the world. We have, since we IPO'd 2.5 years ago, become the largest family law firm in Australia, the only one to have an office in every mainland capital. We're the largest by revenue, we're the largest by staff size, we're the largest by geographical expanse, and we're the largest by accredited specialists. And that's probably been identified by those that provide the accolades in our industry by nominating us for 2 years in a row as Australian Law Firm of the Year. Our growth has been fast and successful, underpinned by our financial performance. But the one thing for all investors that attracts us is the fact that we've entered this market. It's significant, and we've got less than 2% market share. It's a $1.1 billion spend. It's the same size as the personal injuries market, in which there are 3 dominant law firms that each have 10% market share and turnover, $200 million. It's a defensive play. The number of divorces in this country has remained constant. There are 20 different services in family law. Some people say you're a divorce lawyer. In fact, we don't do many divorces. Divorces are just simply filling out a form, but we do everything from children's custody, maintenance, adoption, mediation, arbitration, binding financial agreements, prenups, etc. And the key sort of outtake of this market size is that anyone who's involved in a family law dispute, noting that 50% of the legal relationships in Australia fail, 96% of those end up in the hands of lawyers, and that's a statistic provided by the Family Law Court Annual Report. Our growth since we were founded on the kitchen table of the founder in Melbourne in 2015 has been significant. You can have a look at that in the pack and see our journey. I think there's a couple of significant aspects of our journey, and they are these. It's a combination of organic growth, utilising our competitive advantages. We've grown by lateral hires, where we've opened offices by recruiting people into the business. So in a lot of respects of the growth that we've had in places like Canberra, Adelaide, Perth, the Sunshine Coast, and Sydney, they've all been through an ability to grow without buying or investing capital in those businesses. They've been organic through lateral hires. And there's been some clever affiliations that we've secured with some of the largest consumer law firms like Slater and Gordon, who refer us all their family law work, and Stowe in the UK, which is sort of our sister or brother business in the UK. They're a similar size to us, and we refer clients internationally. Another characteristic is that we've created new products in the family law market as we aim to disrupt it. Everything from AFL Asset Assist to help people during COVID. We've created the Faculty of Arbitration and Mediation, a mediation centre where the courts are referring thousands of cases to mediation. And we've now launched a product off the back of the booming property market called AFL Asset Protect, where the bank of mum and dad obtain legal advice by lending money to their kids to protect them in the event that their kids become, their relationships dissolve. So that's our growth story, and it's led to us being the largest in the country. I mentioned earlier at the preface that I wanted to spend some time on our competitive advantages, and our digital marketing and client acquisition strategy is the cornerstone of our business. And our financial results this year, or half year, have been underpinned by us executing the strategy on a platform that we've now cemented to grow organically. So 55% of Australians start their search for a family lawyer on their mobile phone. And we have built a machine that end-to-end in the value chain captures those leads and secures them for our lawyers to act and assist Australians in need. So it's easy to sort of say, oh, look, I can Google and I see lots of family lawyers out there, and family lawyers will pay consultants to have them optimized and to secure a position on the Google search pages. But that is just a complete waste of time in this market. The real key is the science behind how you use digital, how you target markets, how you synthesize the data and characteristics of the clients that you've acted for to target them, and then use your spend widely in geographies where the tag words are being ignited to make sure that your spend's executed, and then to capture those leads and understand the return on your marketing investment. So this is our competitive advantage, and I wanted to give the investors today and Mark's audience some insights into sort of how that's progressing. This model, by the way, is governed by global experts. So Kevin Lynch is a director on our board out of Unilever. He acts for all the global private equity houses and their digital strategies. We have SEO experts in Texas, San Diego, content managers in Wollongong as consultants, web-based strategists on our website for its compatibility and uplift to mobile connectivity. We have Salesforce as the leading CRM system. Our chief marketing officer who drives all of this was Shine's chief marketing officer when it was a $20 million business, and she took it to a $180 million business. So, we've got the leading market experts globally focusing on making sure that we're ahead of the pack in terms of our digital strategy. And this is our real tailwinds for our business and tailwinds as an investment proposition. So just to give you some insights, and the peppered across the screen there, you'll see references to record months, increased Googles, 90% conversions, and a customer experience team that makes sure the client's journey is a good one in our organisation. But the tailwind's really reflecting on where we're going. So we had a record month in January for new digital file openings. That was beaten in March, in February, and then again, it was beaten in March. So we've had 3 record months in a row. When we floated 2 years ago, we had a record month and opened 70 matters. We're now opening consistently 140 matters a month just from digital. And then on top of that, because our brand is growing and because we're targeting referral-based work, we've got another 27% of files just off the back of the B2B work and marketing and brand positioning that we've done. And that file opening number excludes files from acquisitions such as Watts McRae and Withnells in the Northern Territory. Withnells open 40 files a month alone themselves. So in terms of how it's going in raw numbers of file openings, it's going really well. Having said that, last month we spent 23% more than we normally do. So we increased our spend to capture a bigger market because we could see that seasonally it was a good time to do it, and we could see the activity of where people were searching. But we created more efficiencies on that spend. So we had a 23% efficiency in that our costs per file opening dropped 11%, and our cost per digital file opening in terms of our ROMI dropped by 22%. And so how are we doing this? So we employ many different types of tactics. So the last one we used in March, for instance, is that we looked at the suburbs where there was a high divorce rate. We cross-referenced that to the tax data of what their earnings were. And then you can target specific segments of the market. So that's a tactic that we've used. We've also positioned ourselves in terms of our organic status on Google and our rating. So we run articles. So one article that we ran, as silly as it might sound, How to Divorce a Narcissist, was the highest rating article for family law click-throughs that has occurred in the last 3 years. And all of that's around our brand and drives activity and backlinks through our site. So, those type of tactics are working well. And we're seeing states that when we opened in those jurisdictions like Brisbane, which has taken us, it took a year where digital didn't work to the level we are. It is now our 3rd highest performing state, behind Victoria, that's always been number 1, and Perth, which is an outlier. It's an insane jurisdiction for digital marketing in that jurisdiction. So sometimes it takes time to generate the presence in a marketing sense digitally. But fundamentally, what we do is incredibly clever. It's well utilized and capitalized. There's a lot of smarts and governance go around it. And when you think of the unsophisticated nature of our competitors out there in the suburbs, the small players, there's just no comparison. So I wanted to emphasize that. On top of our client acquisition model, we do use all technology that we can, including outsourcing, to keep the margins down. We've had a significant focus on building the highest quality law service. So we've got 16 accredited specialists, the highest in the market. 7 of our alumni have become family court judges. We have a professor of law that does our internal CLE. So we're building a really strong offering and building the intellectual grunt of our people to offer the best service in the market. And our growth hierarchy, which I alluded to, our organic growth underpinned by digital and referrals, our lateral hire strategy, which has led to our presence across the country, and some of the acquisitions that we've done that I'll talk about. We've got a 4th string to our growth hierarchy now, and that's our partnership model, where for the first time, we've actually entered into a partnership with a lawyer in Darwin, where we own the majority share of that business and she owns the minority, but we work with her in that jurisdiction. And that's a model that we've seen Kelly and partners utilise. And in some locations, it's better that we have a partner on the ground than if we took the risk of owning the whole thing ourselves. And investors will see us roll that model out more, particularly in some of the regions where we share ownership with the principal, utilise their base and turbocharge them through our digital marketing. The highlights since IPO, the last 2.5 years, we've seen our revenues grow, compounding by 50% per annum, underlying EBIT by 125% per annum. Where our run rate suggests that we'll be heading towards a $22 million business with a circa 6 million EBIT this year. 17 offices open to date, the last being in Alice Springs, where there's a family court registrar and we service that out of Darwin. Lateral hires have been a cornerstone. Our marketing is getting better. Our AFL 2.0 strategy that's led to getting us to where we are now will come to an end this June, and then we'll be launching AFL 3.0. And now we're going to go a little bit deeper into the clients, where we'll be able to segment them between sort of parenting cases to property cases to binding financial agreements. And from that, we'll be able to track the type of case to the type of fee that can be generated against the demographic of the client. So it'll allow us to target more lucrative areas and then focus on delivering those at a better margin. And we do clever things that family lawyers don't do with our new service offering. So all of that translates to a disruption of a very antiquated and traditional, highly fragmented space where no one stepped out the front except us. I mentioned our compounding growth success. From an investor highlights point of view, we're the largest in Australia. We're in 17 locations. There are at least another 20 that we've identified that we're focusing on where we can have a presence. Our growth rate typifies the dynamics of the market and our understanding of the market and our ability to position ourselves in it. We've been acknowledged as one of the leading law firms in Australia, which is an honour when you think about some of the larger commercial firms, Minter Ellison, Ashurst, Mallisons, etc. So they're all in the same class as us when it goes to these industry awards. And our management team has executed and delivered what we've said we're going to do. So our half-year results that have been published show that we've had 100% growth in the prior comparable period. The most important thing really is the fact that we've had strong organic growth. So in our numbers, we've taken out the distraction of acquisitions and how you can cloud the numbers and the like. And we've really focused on what we've achieved on the existing core and the business over that period. And we've had 20% growth. Our target is 10 to 20%. Obviously, we're at the outlier of that, which is pleasing. That can change a bit subject to the seasonality, but certainly, I'm comfortable with that, and I'm sure the investors are happy with it. We've expanded again, as I mentioned, to the Northern Territory. File openings are hitting records. And we're currently in discussions with one of the big four banks, just going over documents at the moment to secure a financing facility that gives us some more backing to expand in larger acquisitions. without having to use our balance sheet or without having to raise capital and dilute the existing shareholders. We did a capital raise back in March last year that was oversubscribed and sold out pretty quickly at $5 million. And those investors now want to see a return on that capital raised, and we don't have any intention to dilute them, and debt is better than equity. So our balance sheet is strong now where we can secure that financing. And look, I don't anticipate we'll make an announcement to the market about that, but it's in play, and I can talk more about that in further presentations. But we expect that will be resolved fairly quickly in the next week or so. That's our income statement. You can see the growth without pro formaing the Withnells acquisition in that really came in on the 1st of January. Look, the numbers speak for themselves. I mentioned our digital marketing and our marketing value proposition that underpins the business. We spend about 5% per annum on marketing costs. We have got as high as 8% per annum, or 8% of revenue. So we do have the luxury of spending more on our marketing than most family law firms make in an entire year for their revenue. So our run rate's good. In terms of our balance sheet, our cash position is solid. Sitting behind that is money in trust that people have placed in our trust account on account of fees that we can convert quickly to cash. We can issue an invoice to someone, and within 14 days, under our Law Society obligations, we can convert that from the monies in trust. So it is a very cash flow positive, no carries, no whip, no long tail claims where there's risk around them like you see in the personal injury space. And a lot of investors get us confused or throw us in the bucket of a listed law firm. And some of them in the personal injury space haven't done well. Others in the intellectual property space have. We're different to the PIs. For personal injury businesses, ours is cash in bank and then converted straight away. Okay, in terms of our growth update, so in the last 18 months, we've undertaken 4 acquisitions, a couple small, a couple more significant. Each one of those has a strategic purpose. Watts McRae being a top 5 firm in the largest legal market in Australia, in a segment, an affluent segment, which we haven't targeted from a digital point of view. Cordos is a market leader in Melbourne. So with Cordos, for instance, our average fee in AFL is about $9,000. Their average fee is between $60,000 to $80,000. So it's a high-end business in Melbourne, and we've now merged the 2 companies through an AFL Cordos brand. Canberra, which I'll talk about a little bit in a minute, Strong Law, a small play, and Withnells, which is quite a phenomenal business in the Northern Territory, the market leader, opening 40 files a month. We bought 51% of that business, and that's a business that has been going for 16 years and does not do one bit of digital. The owner doesn't even appear on LinkedIn, and there's no Facebook page. So, it just shows, and its competitor up there that has built a $2.5 million business does all digital. So that market's ripe for us to roll out our digital marketing strategy. Our network expansion. So these are some of our greenfields and lateral hire results. What we're seeing and what you will see as you follow our company is you will see us open hubs in the suburbs, outlying suburbs, north, south, east, and west of capital cities. The buyer of family law services won't normally travel more than 15 kilometres. And some of these areas like Joondalup in North Perth, we started there in July with no matters. We have 80 matters already. The most a lawyer can really handle at one time is 40. So, in 6 months, probably about 9 months, we've grown it to, a 2-lawyer, 3-lawyer practice and continuing to grow. And you will see more of this happen. It's risk-free, it's capital light, and it's strategic. The Canberra is a classic example. So in January 2020, we started that business as a greenfield startup. We brought in a lateral hire. We overlaid it with digital. We rolled in a small acquisition, Strong Law, that we bought for about $350,000, $200,000 up front and $150,000 paid in capital for the owner to work in the business for 12 months post-acquisition. She was looking to retire. The brand had been there for 25 years. We bought that business on due diligence. We found that there was a forward book of work of $1.5 million. So it effectively paid itself off in the first 6 months. And now we're getting traction in that state. We've opened an office in Belconnen in that territory, and we'll continue that growth trajectory, particularly as our digital takes traction. So in terms of our strategy, we, other than the Withnells acquisition that was affected earlier this year, completed in January, we're obviously building a pipeline of future opportunities in terms of acquisitions and lateral hires. I think there's an important aspect to family law that's often forgotten in the dynamic of markets and investments and returns and finances, is that there's an enormous personal side. So we do focus as a business on our core values and fanatical client focus. Our elevator pitch is very much compartmentalized around the client and making sure that there's holistic care around them for all of the emotions and issues they confront in a relationship breakdown. And that's a very important part of our culture and the ethos of what we do for the community through our services and the empathy that our lawyers demonstrate. But the eye on the prize for us is to continue our market dominance. We want to get to 10% of the market. That is, it's a well-trodden path in the personal injury space. That's a very competitive market with large companies. We don't have that competition, so there's significant upside for us. 2020 was our AFL 2.0 strategy. That's been launched and successful. We've continued our growth, and you're going to see more of it over the next 12 months. And that will manifest in our continued organic growth target of 10 to 20%, opening new offices, both greenfields and lateral hire, and some acquisitions. Our acquisition pipeline is strong. We have an acquisition strategy that is working. We do not buy businesses for the sake of being called a roll-up. There are lots of businesses we would reject. 4 out of every 5 that come to us just on a desktop analysis of their numbers and our understanding of their position. So the beauty of us is we've got a lot of people who've been in the industry, so they know who's who, and they know the brands and the presence and the ins and outs of how people operate, just not on their numbers, but also in court. And all of those aspects are important to us in terms of our acquisition strategy. And the acquisition strategy complemented by the partnership strategy, where we will buy part or a majority share of a business and work with an existing owner. So that's our growth trajectory. I think for some investors that sat back last time we spoke, they were wanting to see some more definitive evidence of us growing organically, the strength of our balance sheet, that we've integrated the acquisitions that we've acquired. I feel comfortable we've delivered on all of that. We're going to launch AFL 3.0 in June. And then we start our next step for a business that's got less than 2% of the market and targeting another 8. My objective as the executive chairman is to have the company positioned as a $50 million business with a $10 million EBIT in the next 3 to 5 years. So that's our growth story, Mark. I'm happy to take any questions if you want to moderate that.
Thanks, Grant. We're a little pushed for time, but we'll try and squeeze 1 or 2 in, and then I'll beg a bit of forgiveness from the other Grant. Just on the partnership ownership model, where you're taking the 51% stakes, can I just ask, is there an option to increase that to 100% over time is the first one. And then the second part of that is, you know, you talk about, okay, plugging in the kind of marketing machine to these smaller ones. I'm thinking of the one in Darwin, you know, are they able to scale up with, you know, the volumes that you can bring them? I guess is the kind of next part of that.
Yeah, really good question. So when we do a partnership model, there's a couple of things that we have. Number one is control. And number two is we negotiate a charge back for the services that we get. So we do get some return on the back of house. And the third thing is we get the option to take them out or to buy them out over a period of time at certain intervals. So yeah, we've got all the ability to take control of it. The scaling up is a really good question, and it was remiss of me not to mention it. So, some of the headwinds for us are really around people. So if we launched digital in Darwin, we wouldn't be able to handle the volume. Darwin's a hard place to get people. There's a whole recruitment strategy around how we're dealing with our talent management going forward, from bringing in lawyers from the UK to cultivating lawyers internally. Yeah, our growth in Darwin will be slower than what it would be elsewhere because of the employee restraints or capacity. But you know, we're advertising for fly-in, fly-out lawyers, putting people on secondment. The market up there is too big and too significant for us not to come up with some clever solutions. But capacity will be the barrier for us there.
And then one, I think we'll have to leave it there, Grant. But I would encourage people, if you have questions for Grant, just make a quick note of his email address there and shoot them through. I'm sure he'll be very happy to take any questions offline that people may have.
Thanks, Mark, and thanks to everyone for joining me this morning.
Thanks, Grant. So if we can swap now from Grant in Brisbane to Grant in Melbourne. I see Grant Hackett from Generation Development Group is waiting patiently. So Grant, if you want to start sharing your screen.
Not a problem. Just give me 2 seconds.
I'll let you know when it's coming through. Yeah, I can see it now. Yeah, if you just want to go perfect full screen mode. Yeah, there we go, Grant, looking good.
Beautiful. All right, well, I'll take it from here. Thanks very much, Mark, and good morning to all. So I just want to share my sincere gratitude for everyone joining us today, and just to get a little bit of insight into our company. I'm joined also by our Chief Financial Officer, Terence Wong, who's here for any questions that we have at the end. I know we've got about 30 minutes today, so we'll try and condense the 10 or 11 slides that we've got here in the first 20 minutes, and then obviously do question over the last sort of 10 minutes of the presentation. So let's just kick it off. A little bit about Generation Development Group. We've been around for quite some time. We rebranded back in 2017 when our chairman, Rob Coombe, which a lot of people might know in financial services, who's currently executive chairman of Colonial First State, former CEO of BT, former chairman of MLC, and still the current chair of this group, actually took over the organisation and restructured it, rebranded it, and brought in a whole new team, including myself as part of that, when I used to work with him at BT for several years there, and really re-engineered what we did in the Generation Life space, and with the broader group overall. So to give people a little bit of an insight in terms of how we work from a tax point of view, so GDG has a thing called a PDF, which is a Pool Development Fund license. Now, this Pool Development Fund license allows us to have tax-free capital gains and tax-exempt dividends. The government gave these out probably about 20 years ago to a lot of, sort of biotech, financial services, to mining, energy and resources, just for growth companies. And we've managed to retain that license, which is great for investors. Particularly for people, even if you're an investor and we want to hold your stock, but you want to change entities, you can do that without triggering any sort of CGT liability. So there's quite a few advantages with the head stock from a tax point of view, a personal tax point of view. There's two core groups within GDG, one being Generation Life, which is a wholly owned business, and the other one is Lonsec, which we own 41% of, which is the largest qualitative research group in the country. So let's talk a little bit about some of the results, the CAGR numbers over the past 3 years for the business. So you can see here we've been #1 in inflows in the investment bond business, which is our main product in Generation Life. We've just launched a new product, which I'm going to talk a little bit about today, called Life Income, which is an investment-linked lifetime annuity. So it's the first of its kind product in the lifetime annuity space, a group that you would probably know as Challenger, who've really dominated with well over 90% market share in that space. So it's a new foray for us. And we're certainly looking forward to getting out there and being able to sell that product. And so far, since the launch last Wednesday, so only a week old, we've had a lot of good feedback from our product. But I will go through that particular product a little bit more throughout the course of the presentation today. So you can see there the investment bond business. So for those of you who don't know what an investment bond is, it's not a fixed interest product like a lot of people may think. What it is a legal tax structure that's been around a lot longer than products like superannuation, but it's an after-tax paying product. You can have full liquidity of your funds at any point in time. But if you hold it for 10 years, there's no personal tax liability to declare. And the reason that we got into this space was because back in 2017, there was some significant changes in the landscape of superannuation, of course, with the caps and the non-concessional and concessional caps that came into place. And this being the most tax effective and flexible structure outside of superannuation for an after-tax paying product, made sense for us to go in here because that money just couldn't flow into there. We thought this would be the optimal space to be able to invest outside of the superannuation structure. And that sort of hypothesis has really come to life over the past 4.5 years since we've really ramped it up in this space. So you can see we've had 46% CAGR growth over the last 3 years in terms of our sales. The FUM growth, 32% CAGR for 3 years, and we'll talk about the FUM a little bit more in a second. Our underlying NPAT for the investment bond business, 59% CAGR for the last 3 years. So you can see we're really starting to drive a very strong financial profile within the business. One of the things we really love about money that comes onto our platform is that it has an average duration of 15.7 years. So whilst our acquisition costs are quite high, the long-term annuity that we drive in terms of revenue out of the funds that come into Generation Life is quite significant. So there's not too many money managers, I guess, in the country that have that sort of maturity profile around every piece of investment that comes on the platform. And it's retail money too. It's not like, just over $2 billion worth of FUM. There's huge mandates that come in, for 100 or 200 million. They come through retail investors, and 92% of our inflows come through financial advisors. So it's very, very sticky business. We've got a great track record of product innovation. And I'm going to talk about these products a little bit at the end of the presentation today, but just our tax aware series, which brings our effective tax rate. So we have a headline tax rate of 30% inside the product, regardless of your marginal tax rate. But usually our effective tax rates for a lot of our tax optimized strategies sits at around that sort of 12 to 15% range. We've also launched other products. The thirst for yield, we can see, has been quite significant over the last few years, considering the contracting interest rate environment that we find ourselves in. But you can see there we've got the Generation Life Tax Effective Equity Income Fund, which is a fund that pays sub 10% tax regardless of what your marginal tax rate is, and also the launch of our investment-linked lifetime annuity, which is called Life Income. And like I said, I'll talk about that a little bit later on in the presentation. I've touched on the PDF. We're very much a capital light business model. Obviously, being a life company, Generation Life, we are regulated by APRA, so we do need a small amount of operational capital, which is around 40 basis points of our overall FUM. And that includes our own internal buffer as well. We feel very, very confident in terms of our sales outlook. It's been a significant record year for us, and it's taken us by a little bit by surprise, and I'll talk about those numbers in a second. But one of the things that really underpins that for us, and we can get a kind of good outlook on how we think we're going to deliver in terms of sales growth, is our active financial advisor number. So that number is defined as someone who's written one or more products on a 12-month rolling average. And we also really want to maximize and leverage our life insurance license to be able to pursue other growth opportunities in financial services that also have regulatory tailwinds, which is something that we've certainly done with a lot of the investment that we've made across our new products, or the investment with Lonsec, and I'll talk about that rationale in a second. Here's a quick look or overview of our financial profile of the business for the first half of FY22. So you can see there, revenue up 43%, expenses up 40%. However, $2 million of that are look-through costs, which come through dealing and settlement. That cost, dealing and settlement, is actually the fee between the financial advisor and their underlying client that just goes through the product. So you got to recognize that half of that is look-through costs. In terms of underlying impact, up 57% to $3.3 million for the first half. The development cost for our new lifetime annuity, we raised $10 million in the market, and we said there'd be $5 million spent on developing that product, and we've certainly kept within that budget since we launched it at the end of March. And you can see underlying profit with the inclusion of that, and we like to be able to split everything out just to give clarity for investors and analysts. You can see there is just over 2.8 million. The other income from associates number is what we received from the Lonsec business, that 952,000. Dividend per shares remained unchanged at 1 cent. Fund growth is just over 2.1 billion, and you can see cash and cash equivalents on hand is close to $20 million. Okay, so let's talk about some of the KPIs or the sort of key drivers within the business. Here you can see the live FUM from 31st of December 21, is up 44% from the 31st of December 20 to 2.142 mil. So we've seen a significant amount of growth. Just to give a little bit of perspective on the business. So we've been around for around 18 years. It took 13 and a half years to get to $694 million worth of FUM in the business. After we got to sort of that point in time where Rob came over and sort of brought in a new team and obviously re-engineered and innovated a lot within the product and the structure in the business, we were able to get to $1 billion within sort of 2.5, 3 years post that. And then we were able to get up to $2 billion in less than 2 years post that. So you can see how much that has accelerated. And you can see just from the numbers there over a 12-month period, I think that's up about 653 million from the end of December 20. So we're really starting to see, I guess, the fruits of our labor and a lot of the heavy lifting that we've done over the last few years in terms of educating the industry and financial advisors on the product, how it works, and the new innovations that have happened within investment bonds. Live product sales up 107% in the prior corresponding period, so to 344 million. So a huge jump there for us. Like I said, we've been around 18 years, and for the first time ever in FY20, we cracked 300 million in total sales with 332 million. And now you can see, 18 months later, we're already doing 344 million in a half. And our biggest year was FY21, where we did 404 million. So you can see we've really got that sales momentum, and that certainly has continued into the second half of this financial year. Market share, 45.2%. On the last quarterly numbers, we actually did 52% in the quarter, so it's great to see that we continue to take more market share. And the great thing about the last quarterly numbers is that the overall market of inflows actually grew by 50% as well. So not only did we increase our market share, but the pie or the opportunity to ascertain inflows has also grown as well. So a really, really good stat in terms of where the business and the overall opportunity in the industry is heading at the moment. APL is very important, approved product lists, to make sure that we get access to distribution through all the various dealer groups and financial practices, up 20% to 544 million. We've had our highly recommended ratings from both Zenith and Lonsec for quite some time. So Lonsec we've had for about 5 years. We've only owned that 41% share for around 18 months or just over. And Zenith we've had for around 15 years now. We've been a highly recommended product, which helps with those APLs. Active financial advisors up 21% to 1,601. We've had to invest a lot in terms of automation. You can see that just from the new bond numbers. So up 64% on the same period last year to 10,774. So a lot of additional processing that we do in the business. If you look back at FY17, we did 2,266 new bonds for the entire year. That's now kind of 3 to 4 weeks worth of work for the business. Savings plans up. So a lot of people will invest in the product and then they attach a direct debit savings plan. So that's up 23% to 30 million for the half. We've increased our investment options on our investment menu to up 16% to 58, and also the maturity profile, which I've also spoken a little bit about. I'll quickly touch on the side because this talks about I guess, total market share and market share of inflows. So what you want to see here is the biggest disparity between the bar chart and the line graph. So you can see there, we're taking a lot more at Generation Life in terms of our natural market share there, that 45.2%. And you can see our main competitors, Australian Unity, Futurity, IWF, and Centuria, are not quite getting their natural market share because obviously we're taking the lion's share of inflows. And we're also getting very, very close to Australian Unity in terms of total market share, where we currently sit as number 2. Okay, so this just talks around the trend of the business in terms of fund growth over the past 5 years. So you can see there back in December 17, 797 million there on the platform. Like I said, a couple of years later, we cracked that $1 billion mark. But you can see that the massive amount of growth that we've received over the last 12 months. And like I said, that momentum has continued into this calendar year, regardless of the volatility that has come back into markets. And I think that's just the foundations of the business now, and the fact that that active advisor number, the support that we have through financial practices is so strong. I've already alluded to these numbers, but you can see now the graphical representation of it, or illustration of it here, that 332 million of total sales, of gross sales that we did in FY20. Fast forward to the first 6 months of this year, and we've already eclipsed our second best year in the history of the business. And no doubt, we obviously can't talk about numbers because we're not doing a release right now, but certainly that 404 million will be beaten this financial year by quite a significant margin, given the run rate at the moment. So we want to talk a little bit about the operational leverage in the business, particularly when you look at our financials, and it's hard for some people to identify some of those look-through costs without speaking to Terence or myself. So this is a great way to demonstrate that financial leverage that is coming through the business, which is a common metric in financial services, is profit per employee. So you can see there that we've had significant growth of around 30 or 40% from FY20 to FY21, just in terms of what we've been able to drive per average headcount. Okay, so let's talk about our acquisition into Lonsec, or our investment into Lonsec. So Lonsec, for those of you who don't know this business, it's sort of 4 key businesses, one being the research business, Lonsec Investment Solutions, which was a key growth driver that we rationalized the investment into the business, Super Ratings, and also iRate, which is our analytical software that over 4,600 financial advisors utilize for a lot of their portfolio construction and help with their clients. So originally we did 37% when we did this acquisition back in October of 2020, and then through a selective buyback, we managed to get up to 41%. Revenue numbers have been very, very strong, up 24% on PCP, and you can see EBITDA is up 22%. When we went out to market on our full year results, we actually said it's going to be a flat year in terms of growth, because we have a 3-year accelerated growth plan that's been agreed to by the board and the executive there, which they're 6 months into executing. So this was going to be the year of investment. We've done the majority of that investment, and we just happened to grow, much more materially than what we anticipated in terms of the research business, and also Lonsec Investment Solutions, which I'll touch on in a second. And we know post the Royal Commission that this business was very well positioned, because of its independence, to capture a lot of the portfolio construction that used to be done by financial practices or by dealer groups, that now goes out to consultants or to businesses like Lonsec or Zenith. So just to talk about what really drove that investment into Lonsec, and part of, I guess, the rationale for us at GDG was this Lonsec Investment Solutions, or the managed account space. So it took them 3 years in June 20 to get to, it was around 659 million. We thought we'd get up to about a run rate of about 100 to 110 million if we invested in them, we got the strategy right, and we were able to articulate the sales proposition, correctly out to distribution. However, that run rate has been materially greater than what we anticipated, which has been sitting at about $140 million per month. So you can see there, December 21 closing at 2.75 bill is much, much higher than what we anticipated, and kind of what we promised the market when we were looking at this acquisition 18 months ago. And that run rate, again, like the investment bond business, has well and truly continued into this calendar year. Now, I'm just going to quickly finish on this slide and then throw it back to Mark just for a few questions. But you can see there, It doesn't sort of stop there in terms of what we're doing. We've got a lot of, I guess, key product strategies that we're executing out in the market right now. The Generation Life Tax Effective Equity Income Fund, you can see the performance of that fund's been great, but what we really drive is what we call tax alpha. So you can see there the headline strategy, as much as it's delivered well and truly above benchmark, with a 16.1% return after tax and after fees for an investor, regardless of their marginal tax rate, it's delivered 13.1%. So could you imagine doing that same investment as a person who's on a 47% marginal tax rate? You wouldn't have net in your hand to be able to take home and put in your pocket 13.1%. So you can see our innovations are really driving the after-tax performance of our products. Investment bonds and the tax optimized funds. I've already touched on the tax optimized strategies, which is about 15 options out of the 58 that sit on our investment menu that have a tax rate of 12 to 17%, like I said, regardless of your marginal tax rate. So that's an average tax alpha of 70 basis points per annum. For some funds, it's been as high as 300 basis points per annum. And that's the Generation Life Tax Effective Australian Share Fund. I won't go through the rest of that because I know we're a little bit starved for time. However, I do want to touch on our investment-linked lifetime annuity, which is Life Income. So we launched this in March 22, so only a week ago, like I said before. This guarantees income for life, like a normal lifetime annuity. That is secured by Hanover Re, which is the third largest longevity risk reinsurer in the world, with a AA- credit rating. So you couldn't get a stronger balance sheet to be able to support the guarantee of income for life around this type of product. What this product allows retirees to do is that, depending on where you sit in terms of your financial resources and assets and whether you're a couple or a single, when you invest in this type of product, you get a 40% discount of the capital amount off the assets test. So therefore, you can more easily access more or some of age pension. And we all know the various concessions that come with accessing the pension card. You're able to receive more income sooner with this product, because what we do is, through our Life Booster feature of this product, and I can't go through everything now, we're able to bring a lot of income forward. So your starting income is a lot higher. The reason we've done that is because it fits in with the retirement life cycle and behavioral patterns of people in retirement. So say you're retired for 30 years, the first 15 years naturally is where you do most of your expenditure, because you travel, you're healthy enough, physically able enough to get out there and do all the things that you want to do. And then when you get to the back end of retirement, whilst your medical expenses might go up a little bit more, your actual overall standard of living is not as expensive. So therefore, we've been able to balance that growth of that income out. And you can imagine the value that you receive in it, because it is investment linked. So it's attached to a unit price of just a normal fund manager, like a Vanguard, like a Dimensional, like a BlackRock. You know, we have 23 options that sit on our menu. So it will grow significantly over time. But what we've been able to do, instead of being able to, I guess, have all that back end growth like you would in terms of the time value of investing, we've been able to develop a feature within the product that brings some of that income forward in today, where you can actually enjoy it. So we're really, really proud of what we've been able to innovate there. And so far, the feedback that we've received from a lot of the financial advisors that we either do business with or haven't done business with previously, but are certainly quite active as a financial advisor in the lifetime annuity space, really like what they see of the product so far. I think that's pretty much it from my end. Mark, I can hand it over to you, but I've already touched on all this. Great sales momentum, fun growth in the business. You can see the innovation that we've got going across the team, expanding into new markets. Look, just to give you an idea of, I guess, the post-retirement asset market, from a relative point of view, it's growing faster than superannuation. So if you look at the market today, it's about $686 billion worth of assets. Let's fast forward to 2030, it's going to be about 1.5 trillion. So it's all that baby boomer money shifting from, I guess, accumulation into decumulation now, and there's been limited products. And we have gone into that space because there is a lot of legislative tailwinds, whether it was a retirement income review or the retirement income covenant that's just been passed by the government, attenuation funds that trustees have to comply with. And look, we've been very focused on executing the Lonsec 3-year accelerated growth plan. And in the first 6 months of that, we've certainly delivered results that were far above expectations. So we certainly have big hopes for that business. And yeah, the numbers kind of speak for themselves. So thanks very much for everybody's time today. Much appreciated. I know there's a lot to get through in terms of our business in 20 minutes, but I hope you got a bit more of an insight into the trajectory of the business at the moment and how it's performing and a lot of the innovations that we're bringing to the market. But I'll hand it back to you now, Mark, for any questions for Terence and I.
Thanks, Grant. Yeah, the questions have been coming in thick and fast. I'll just go through them here now, and look, either you can answer it, or if it's more applicable to Terence, he can just like jump in. The first one is, with the Lonsec stake, is there a pathway to full ownership, or should we kind of consider an associate for the foreseeable future?
I'll default that one over to Terence.
Thanks, Mark. I would rely on the latter, just work off the basis there'll be an associate in the foreseeable future. Main reason being that there's two reasons really. One, we're a PDF. With being a PDF, there are constraints, and we would struggle to increase our interest in Lonsec without having to relinquish our license. And so that's one down. And the other item is the fact that the other shareholders really like what we've done with the business in the last 18 months. And more importantly, they are very excited with the prospects of the accelerated growth plan. So naturally, their price and value expectations are materially different now to 18 months ago. So they're not willing or considered sellers at this point either.
Okay, thanks. The next one, and I'm going to preface this by saying the federal election is just around the corner. The 2025 personal income tax plan has an impact on the value proposition for the investment bond business, flattening marginal tax rates, lack of CGG discount available to insurance companies. I guess the question is there a strategy to, they say circumvent, but I think is, a strategy to, deal with these potential changes given, what's on the table, from the treasurer at the minute, but 3 months from now, we could have a different treasurer in place. So maybe just comment on what your thinking is at the minute.
Yeah, correct. And who knows what other sort of tax changes are going to come through on the basis of that, particularly if it's a Labor government and if they do, anything that they were talking around the last federal election when Short and Bowen were looking like they were going to get into power and obviously never came to fruition. There could be, a vastly different landscape. But in terms of this, of course, we've definitely put some thought into this. A lot of our tax optimized series, because we work on revenue accounts. So I know it says there the lack of CGT discount available. We work on revenue accounts. So when you work on revenue account, you can offset a capital loss against income. So we can bring our, annualized tax rates down quite materially. And that's the reason that sort of 12 to 17% effective tax rate is actually possible. And a lot of our underlying investments. So even if that market that goes to, and we've done this analysis and we can demonstrate it to anyone that wants to see it, that even a person on 30% tax rate, if they were to doing it as pay as you go or investing somewhere else, there is still a tax arbitrage with us. Obviously, for people on the 47%, which of course includes Medicare, it's a no-brainer. The arbitrage is huge. The other aspect to our product, 55% of our inflows, the core use for them is actually estate planning, because an investment bond can be structured as a non-estate asset. So therefore, you think of wealthy families, you think of people that have got blended families, high conflict families, equalization of estates, grandparents wanting to skip a generation because their kids might be having trouble with their marriage or could be divorced but want to look after the grandchildren. You can do that through the investment bond structure. And we've got a thing called a future event facility, which can vest over multiple periods. So depending on percentage or dollar amount, you can actually control how and when those funds are distributed. So if you wanted to say that 7-year-old can't get access until they're 25, you can do that, and we hold it in trust. But if you even wanted to say they can only get 10 or 15% of that for the first 10 years of access that they have it, then lift that restriction, you can do that as well. So there's a lot of flexibility within the structure. So yeah, still a tax arbitrage there for the people who's coming down off potentially off the 39% down to 30% for the range that you've discussed. So we certainly still got an arbitrage across a lot of our products, but big arbitrage for people on 47%. And also, you've got to remember, we pay the tax as well. So from a cost effective and compliance point of view, when it comes to your tax, we're a very, very easy solution from an investment point of view. And we do save money on that front as well.
Okay, the next one, in terms of growing inflows, are there any main, dealer groups, license groups that you're not with, that you'd like to kind of bring in under the umbrella that would make a step change to the reach that you would have then?
Yeah, I mean, there's always opportunities out there. I won't name names for obvious reasons, but there's probably, we have very good relationships across the vast majority of dealer groups, but there's a couple of big ones out there that we don't currently have a relationship with that we'd love to, and, an opportunity to be able to work with their financial advisors and underlying clients. So we still see those as potential, uplifts in our inflows. But look, if you look at the amount of financial advisors, it's supposed to flatline at around 13,000 next year. I would anticipate that active financial advisor number, the active advisor number that I spoke through the presentation, should, kind of get up to 3,000 or 4,000 over the next few years, particularly with the life income, the lifetime annuity product that we have now. So I think whilst we've been able to educate the industry and we've seen a massive inflection point over the last couple of years within the business, I still think there is a huge opportunity out there with existing dealer groups that we have relationships with, but a few of those ones that we currently don't as well.
And I'm going to finish on this question, even though we're slightly over time, but it's just a good follow-on question from that last one. How should we think about the cost base from this point on? As previously, and you've mentioned, a lot of investment has been put into the business, the product, educating the financial advisors. Is kind of, you're there now, and it's just more kind of care and maintenance marketing to say, hey, you guys just keep us in mind, or keep yourselves top of mind. They know the products are there. It's just making sure you're on their radar when they're looking for a solution for clients.
We would definitely expect operating leverage to improve even further over time, but at the same time, we'll continue to reinvest in the business. So we are very careful in terms of how we spend our funds. But it's also very important to remember the tenure of the bonds that comes onto our platform. So to the extent that we bring on more salespeople and they sell an even larger amount, or we have even more innovative products coming through, that costs money to develop. But you have to remember the tenure of the bonds, they're north of 15 years. So even if you make slimmer margins in the initial year, when you bring the sale of the new funds onto the platform, subsequent to that, the cost of maintenance negligible. So for example, on a net basis, we earn between 80 to 90 bips on the bonds, but to service that cost going forward, once it's on the platform, it's quite negligible. It's a couple of emails, a couple of letters, a couple of phone calls. So a lot of it goes through to the bottom line. So you will get operating leverage in the long term.
Okay, thanks, Terence. Thanks, Grant. We're going to have to leave it there. Unfortunately, we're out of time. For anybody whose questions I didn't get to, apologies. But hopefully you've had a chance to take down Terence's email address, and I'm sure he'll be happy to take them, and indeed Grant, take them offline.
Absolutely. Thanks very much for your time, everybody, this morning, and appreciate the opportunity, Mark. Have a good day.
Thanks, everyone.
Yes. So we're going to flip now from Melbourne CBD up to Bendigo, because I know Chris is waiting for us. Yeah, Chris, I can see the cover slide of your presentation now.
Yeah, thanks, Mark, and it's great to join the Coffee Microcaps meeting today. So I'll just kick off and I'll give a bit of a snapshot on Apiam. So as many of you will be aware, Apiam is a veterinary group. We're the only ASX listed veterinary group currently, with Green Cross and National Vet Care having been taken off market in the last few years. Our business is very focused on the rural and regional veterinary clinics. We do a couple of peri-urban, but it's very much around providing veterinary services across the whole spectrum of animals, from production animals like cattle and sheep and pigs to companion animals like the dogs and cats and the pocket pets. So our clinics are located in large regional towns or regional cities, and maybe surrounded and supported by satellite clinics in some of the smaller regions. We've got 73 clinics in the group and over 250 veterinarians. If we look at the business over the last few years, it's got a fairly attractive financial profile. We continue to deliver year-on-year growth, and we're starting to really leverage that at an EBITDA level. We have been paying a dividend, but obviously we're on a very accelerated growth strategy at the moment. So the board will review our need for capital and whether that continues as they do every 6 months or so. There's a very strong industry outlook for regional veterinary markets, and I'll talk to that a little bit more in a minute. But obviously, you know, the regions are booming. People are moving out of the cities, and we're going through a very good season. Apiam is currently undergoing an accelerated growth strategy, and I'll talk about the industry dynamics that are really driving that a little bit later. But our growth is really being driven by organic initiatives that are occurring across our dairy and mixed animal clinics, the acquisitions that we're making, as well as a small number of greenfield clinics that we've been implementing. And we've got a strategy to double our revenues base to $300 million by FY24. And as I'll go through, it's more than an aspiration. It's actually a strategy where we've got some very good building blocks in place to be able to deliver on it. So just a bit of an overview on the business and what makes up our veterinary portfolio. So 70% of our revenue comes from what you consider to be typical veterinary clinics, mixed animal clinics that are in regional cities and towns. And those clinics involve people bringing their dogs and cats into those clinics, and then also having vets go out into the field onto farms to provide services to the farm animals. The business, in addition to having sick animals come in, is that we offer a couple of wellness programs. The Best Mates program is a wellness program or subscription program for our companion animal business, and our Pro Dairy is a similar program for our dairy industry, and both of those are growing extremely rapidly. Consultancy and services makes up a large part of this business, but it also provides or develops revenue through prescription products, other products, as well as OTC retail products. We do have a integrated supply chain, and as it's very much integrated into our intensive animal, but it's also providing products directly onto farm for our dairy industry. What's different about Apiam is that rather than just being an aggregator of clinics, we also have a number of services that then leverage in across that animal footprint within the clinics. And in this part of the business, it's our diagnostic lab and pathology services and feed testing, and some of the parasitology services, which is a growing part of the business that we're leveraging across those clinics and our client base. And that part of the business is growing rapidly, which I'll talk to on the next slide. The other part of our business is our intensive animal services, and this is really servicing the beef, pig, and some poultry business. This involves providing consultancy services, and the majority of the revenue is delivered through sales of products. So these can be vaccines as part of preventative health programs or the prescription antibiotics. We have an integrated supply chain, and you'll see on that illustration to the right is that the veterinary services are being provided in, but they're supported by other parts of the business to really leverage off that relationship and to deliver in other services that add value to our clients and make them more profitable. So that's from genetic services, providing data analysis services, as well as products and other tech support. We have a diagnostic lab and a vaccine lab, which we acquired a couple of years ago. And this is, again, another growing part of the business that I'll talk to later. If we look at what's happening from an industry point of view, well, regional Australia is, going extremely well at the moment. There's a rapid regional veterinary market growth event occurring. And this has sort of come from the start of COVID, and where we saw net migration of people from the cities into the regional areas. We also saw with lockdowns that both in the cities and in the country that there was an increase in household pet ownership, and that's between 15 and 20%, depending upon whereabouts in Australia that's located. So in addition to people moving out and getting pets, they also moved on to hobby farms, and we've seen an increase in the amount of livestock that we're servicing in these rural and regional areas. Those animals that they got during COVID played a really important part in the life of people and their support mechanisms. And as a result of that, we're seeing a change where they're really treating those animals as part of the family, and that's resulting in an increased spend in vet care. So we've got the skill sets that can really be applied across all the different animals, and so that's really the area that we're focusing on, is that regional and rural areas. When it comes to the production animals, obviously the La Nina event is occurring, and we've had significant rains across the country, and that's supporting our strong pasture-based livestock industries, where they not only do they have access to fodder now, but they've been able to put it away for the next 2 or 3 years. So what's been happening in the industry from a veterinary point of view is vet clinics have been growing, and that growth has been exceptional in some regions. Our like-for-like growth in this area in the first half of this year was just under 10%. But what that's doing is that's putting a lot of pressure on veterinary clinics and their ability to resource additional vets, as well as manage that growth. And as a result of that, we're seeing a move where a lot of these clinics are now wanting to move into a corporate model where they can get the support around developing the business and capturing that growth, so they can, while they focus on the veterinary services. So just to give an overview of what our strategy is to double revenue to 300 million. So there's really 3 revenue growth drivers. So the first one is the acquisition pipeline that I just spoke to, and we've acquired 20 businesses over the last few years. In the first half of FY22, we acquired 7 businesses, which included 11 clinics. During the first half, we also brought forward our investment in the head office support services, so that they're now in place to be able to continue on that growth trajectory over the next 12-18 months. The other part of our growth that will contribute to this revenue is organic growth, and as I said, the regional veterinary industry is growing, and there's good outlook across all of our markets. We've also been developing a number of new products and services, and these are starting to enter the market now and will really mature over the next 2 or 3 years. Where we can't acquire clinics, then we've been looking at doing greenfield sites. We've done 4, I think, in the last 18 months. These do affect the business in the first 12 months, in that they do require capital, and then they also have an effect on our EBIT, because they do suffer loss in the first 12 months, but at 3 years maturity, they're starting to deliver really good results. So we'll see that come through over the next 2 or 3 years. But it's not just about revenue. Obviously, we want to see that at the EBITDA level and at the EBIT level. So our strategy is to really leverage from those investments that we've made across new services and products, and be able to leverage that at the bottom line. So if we look at where that will come from, well, we did accelerate our costs into head office, and now what we'll see is we'll get further operational leverage from the acquisitions that we made in FY21 as well as the first half of this year. So those costs are largely in place, and as we move forward, you'll see some EBITDA margin uplift in the second half of this year and then into the next couple of years. There's obviously the contribution of the greenfield sites and the high margin businesses that we're acquiring, and our high margin products and services will also be contributing. So just a quick overview on what's happening financially, and this is based on the first half of FY22. Again, we saw a 22.7% increase in revenue. Our gross profit's growing faster than what our revenue is, and that's because of the parts of the business that are accelerating are higher margin parts of the business. And you'll see that our EBITDA and our NPAT have also grown, and as I said, they've been held back a little bit by the investments that we've made in the first half. and then the NPAT, also affected by, a one-off $1.2 million in stamp duty that we had to pay in Queensland for the acquisitions there. We also had some additional costs in relation to when the borders open, and we were able to bring in some vets from the UK and South Africa. So we had an additional $200,000 in immigration costs that we wouldn't normally have. The business generates very good cash flow. We were at 92% of underlying EBITDA in the first half, and that was even when including the stock build-up that we did in December to prepare for what we could see coming with supply chain disruptions, and that's been winding out since the end of the year, and we're expecting that operating cash conversion to further improve. So just having a look at what's happening, within those segments. So as I said, dairy and mixed animal clinic, it's growing very, very fast, and it's growing in line with our strategy. Over the last 12 months, it's gone from being 60% of our revenue contribution to over 70%, and we expect that to continue. If you look at this segment alone, and I said this segment makes up 70% of our revenue, it had 44.9% growth at a revenue level and 36.5% at an underlying EBITDA level. And on a like-for-like basis, it was at 9.3%. So that has been dragged down. When you look at our overall like-for-like growth of revenue, it's just over 1%, and our like-for-like gross profit growth is just over 4%. So that's been pulled back down by the industry cycles that are occurring in the pig and feedlot industry. And if I really talk to the feedlot, because this is, these numbers are well known and well reported across industry, that from 2019 we saw a reduction in the national cattle herd as drought was having a real effect on the industry. Since then, we've seen a rebuilding in the herd. So, and particularly in the last couple of years, as it's rained across the country, we've seen a rebuilding of this national cattle herd. And what that's meant is that there hasn't been as many cattle to female cattle to come into feedlots, which is where we provide our services in this industry. So as the cattle herd continues to grow, and you can see on the national cattle herd number graph there that it's forecast to continue to grow over the next 2 or 3 years, then there'll be more cattle that'll come onto the ground that'll be entering into feedlots. And we've started to see this in the last couple of months, where these cattle, which are now hitting the right weight to come into feedlots, are starting to flow in. And we're expecting this to really change as we go into the spring of this year and into autumn of next year. So just to drill down a little bit more on our strategy to grow the business, and just a few of the things that we're doing. So from a product point of view, we acquired a vaccine facility 2 years ago. In the last 2 years, we've brought three new products to market for the cattle industry. This facility makes vaccines against bacteria. There's a huge gap in the market in terms of that there's no autogenous vaccine facilities that are really dedicated to making vaccines against viruses. So we're going to expand our facility to be able to do this. We were awarded a $700,000 grant through the Victorian state government last week that will enable us to fast track this growth. So the facility is not expected to be fully completed until 2025, but we're building it on a modular basis. So we're expecting to be able to start producing vaccines within the next 12, 18 months. Obviously, from an industry point of view, there's a priority to look at a vaccine against Japanese encephalitis, and we're working with several university research partners to look at how we can bring this to market as soon as we can. But we're going to be producing several vaccines against viruses where there's gaps in the market, and there's currently no commercial operator. The way that our vaccine facility works is that it's not a commercial vaccine facility that pumps out millions and millions of doses. It's basically a facility that has a permit to produce vaccines, usually specific to a farm or a production system where there's currently no commercial vaccines available, or the commercial vaccines are no longer effective, which can happen as we're starting to see antigenic drift and mutations occur in some of these pathogens. So we effectively take that bug from the farm, we make a vaccine, and then we supply it to a farm. In the event that it's a larger sort of industry issue, then we can get a permit to supply a vaccine up to about 10% of the total animals that are in an industry. So it's a crucial part of the industry in terms of being able to fill gaps where commercial vaccines aren't available. And bearing in mind that a lot of our commercial vaccines are manufactured in the US and Europe, and so we do at times get subject to supply chain disruptions. We've got some other products that were also recently launched. Extend 21 is a quite a unique surface protectant and disinfectant product that it's manufactured by Zuno in Australia and in New Zealand and in the US. We spent 2 years doing research on this product. The main research being done at Iowa State University, where we've shown 21 days surface protection against two of the main viruses that occur in that industry. We've partnered up with a US pharmaceutical company, Aurora Pharmaceutical, and they've recently launched that into the market. So we'll see how the uptake of that is over the next 6 months. In terms of service programs and getting organic growth, there's two programs that I mentioned earlier. So our Best Mates program, we've had exceptional uptake on that. We've got that into about 7.6% of our active patients. And we're expecting to be able to grow that based on what some of the other large corporate groups have done, up to around 15%. But our third quarter of FY22 had member growth of 37.5% on the previous comparative period. What's great about this program is when we do make acquisitions or greenfield clinics, then we can apply this program and we do get some immediate uplift. The other program that we've rolled out is Pro Dairy across the dairy industry, initially in Victoria, but now we're expanding it into Tasmania and New South Wales. We saw a 75% growth in dairy farm enrolments in the first half of this year compared to the first half of last year. And we've now got about 15% of Australia's dairy cows enrolled in the program. So this has really enabled us to grow our market share in the dairy industry. Just talk briefly again on our acquisition programs. So as I say, we've got an extremely strong pipeline of acquisitions. We probably go further on probably about 25% of the acquisitions that get put in front of us. We've got very strict criteria around the clinic that we want. And we need to make sure that it's going to deliver synergies and particularly growth synergies after we acquire them. So culture is a very, very important part of it, and we also really like larger clinics that have 5 or 6 vets as a minimum, and if they have 15 or 20, it's even better because you've got succession plans in place and you've got the resources to deal in these remote and regional areas when vets are on leave and to cope with the after hours and weekend work that's required. But you'll see on the right, we've been fairly active in the acquisition space, particularly in the first half of FY22, and we've clearly been out there communicating that we're expecting to continue at this rate over the next 6 to 12 months. There were 4 acquisitions that we made in December, so they really didn't contribute too much to the first half of the year. They'll contribute further to the second half, and the acquisitions we made in the first half on an annualized pro forma basis contribute about $25 million to our revenue. I'll just touch slightly on our greenfields, and as I've mentioned before, we've done 4 of them in the last 18 months. They do have a drag on both our EBIT in that startup year. In the first half of FY22, they had a $900,000 impact at EBIT level. However, they're very good return on capital when you look at the third year and beyond, and we expect them to get up to around 15 to 20% underlying EBIT margin. So if we look at the outlook for our business, we've got a very clear strategy to aim to double the revenue by 300 million by FY24, and as I said, 2/3 of that at least will be in acquisitions, and we've got a very strong pipeline where we've got those acquisitions under various sorts of agreements or in various levels of discussions to bring them in. So we're very confident in terms of being able to execute on our acquisition strategy. We've already invested in the infrastructure or a large part of the infrastructure to be able to do the accelerated acquisition program. And as a result, we're expecting as we do these acquisitions going forward that we'll get uplift in our operating earnings. So with that, Mark, I'll open it up to any questions.
Thanks, Chris. I might just kick off with one or two and get the ball rolling here. I mean, as you're getting bigger, does that open up more partnership opportunities? You know, I'm thinking of like the pet insurance guys or the pet food group guys, or you know, maybe not so much on the kind of commercial ag side, or potentially with the commercial ag side, like with you know, the elders guys or whatever. I'm just wondering, now that you're getting to a fairly, you know, more than significant scale, does those opportunities start coming your way now?
Yeah, look, I think in the last 12 months, we've certainly seen more opportunities flow our way in those companion animal services. So, you know, if you go back 2 years ago, you know, most people would consider that we were a veterinary services provider to the farm animals. But you can see by our numbers that it's changed dramatically. And we're certainly attracting the interests of those companies that supply products into companion animal clinics who want to partner with us to really drive some of the growth around their services and products.
We've got a question here, just in what's been the impact of the recent floods in Queensland and New South Wales?
Yeah, so in Queensland, we had one clinic that was significantly affected in terms of their infrastructure. So our Gympie clinic, that clinic was built to the 100-year flood levels, and the floods had to get to 20 metres. Well, they got to 23 metres. So that clinic's currently in the reconstruction process. We got a great team, and between the clinic team and our management team, within a few days, we were able to identify some other properties on higher ground where we could totally re-establish some satellite clinics, and we're currently operating out of several of those clinics. So it certainly had an impact, you know, from a people point of view and the amount of work and everything that's involved in it. But we've been able to continue to provide services to our clients. We had one other clinic, which is at Agnes Banks near Richmond, just out of Sydney. Again, the property itself wasn't impacted, but with the Hawkesbury up, we had to separate our teams into either side of the river, and we were using SES helicopters and boats and to get to distressed animals and to be able to treat them. So, you know, it's really been that inconvenience, and it's more than inconvenience. I can say it's been a toll on our people, but we've still been able to deliver the services that our clients have required.
Another question. Do you have issues recruiting new vets, and are you planning on recruiting more vets from overseas now that the border is open up? And if I could just tag on to that, as you now have got bigger as well, what's the capability internally for vets to, you know, move between practices? You know, somebody who, you know, is based in Victoria but wants to, you know, go up to Queensland, for example, and you know, have a bit of a lifestyle change for a 2-year secondment, for example.
Yeah, so I'll answer the last one first. So yeah, look, we do that and we promote that because we realise that particularly in that first 5 years, vets want to move around and have different experiences. Particularly in a business like ours, where we've got experts in different regions, they may want to look at specialising in a certain region, so that, you know, or area, so they're going to move that way. Certainly, you know, we also, you know, what's great about our clinics is we do operate them on a regional basis, which means we can move our resources, whether that be vets or vet nurses, between clinics. And we also see where we've got areas that are, you know, difficult at times to attract vets, that will have vets in other clinics, particularly when they don't have that, you know, when they're seasonally based, particularly around the dairy industry clinics. They'll move interstate to other clinics, and we've got a few vets at the moment who are currently doing that. In terms of issues recruiting vets, I mean, it's been an industry issue with not being able to bring in vets overseas. However, I think we've been, we're a large group and we've been able to absorb some of that, but I think we're also been in a pretty good position in terms of what we can offer to future vets, who want to join Apiam or join into the rural areas. And so, I think we've got a very good, employee value proposition. We're very active in the veterinary schools as well as across the industry in recruiting vets, and we do have a very low turnover compared to industry. In terms of recruiting more vets from overseas, what we did is, our strategy when we're under pressure with that growth was to recruit experienced vets, and so that's why we brought some experienced vets in from overseas, and we also recruited some experienced vets locally, and that's because some of those were from clinics in the remote areas that were closing down. So in terms of in future, we'll always recruit, look at recruiting overseas vets, particularly from the UK, because that's the way the industry works. Australian vets and UK vets tend to move between those two countries, usually in the first 5 years of their career. And so that's something that will be ongoing, but it's certainly, we won't have the cost of what has happened in the first half of this year, where we basically had a backlog of vets that we'd had lined up for the last two years.
And then another question from me, in terms of the kind of specialist expansion, you're talking about the vaccine space. Are you looking at, more specialist veterinary surgeons? I'm thinking of this more the companion animal side now, the vets who do specialist orthopedics, specialist dental, even the oncology space for pets is a huge sector, growing sector that I know of now. Is that something you're looking at as well?
Our aim is to try where we can possible to keep services to those rural and regional animals in the rural and regional areas, rather than having to be referred to the cities. So it is a process, but we've been rolling that out across the company, where we've got a couple of facilities now that have CT machines, and we've been internally skilling up our vets to be doing a lot of the surgery that animals used to be referred to the cities. So we're seeing some emerging trends in the veterinary industry around new services. So we've got a vet who's doing behavioural services, which is something that has really grown. As we unwind from COVID, and we get separation anxieties issues that are occurring in pets. And then there's other areas such as dentistry, which is a real growing segment where we're skilling up people internally. But it is something, it is the aim of our company to have those specialist skills that we can then deploy.
Sorry, everyone, we seem to have lost Chris. I think let's leave the meeting there for today. Thanks everyone for joining. Sorry we got cut off there just at the very end, but we will have another meeting next week, and I look forward to seeing you all next Thursday.